Building long-term wealth isn't about getting rich quick. It's about making strategic investments that compound over decades. The difference between millionaires and everyone else isn't secret knowledge. It's consistent investing in proven assets over time. Today, I'm revealing the best investments for building long-term wealth. These aren't trendy assets or speculative plays. They're time-tested investments that have created generational wealth for millions. I've used these strategies to build substantial wealth over 15 years. They'll work for you too. Welcome to Wealth Wisdom. If you have ambitions to achieve financial success, please leave "yes" in the comment, and we are here to help you obtain insight and build wealth. Investment 1. S&P 500 Index Funds. The S&P 500 has averaged 10% annual returns for nearly 100 years. It's the simplest, most reliable wealth-building investment available. You get instant diversification across 500 largest U.S. companies with minimal fees. Warren Buffett recommends index funds for most investors. He's bet his reputation on it. In his will, he instructs trustees to invest 90% of his wife's inheritance in S&P 500 index funds. That's the ultimate endorsement. I started investing $500 monthly in Vanguard's S&P 500 ETF 10 years ago. That's $60,000 contributed. Today it's worth $110,000. The math is simple but powerful. Consistent contributions plus compound growth equals substantial wealth. The beauty is simplicity. No stock picking. No timing the market. No stress. Just automatic monthly investments regardless of market conditions. This strategy has never failed over 20-year periods. Buy VTI, VU, or SPY. Set up automatic monthly investments. Reinvest dividends. Check it once yearly. That's the entire strategy. Boring works. Investment 2. Total Stock Market Index Funds. Total market funds go beyond the S&P 500. They include small and mid-cap companies, offering even broader diversification. VT Sachs and VTI are popular choices providing exposure to virtually every publicly traded U.S. stock. This gives you ownership in over 4,000 companies. When the U.S. economy grows, you profit. It's betting on American capitalism long-term. Historically, that's been an excellent bet. I allocate 40% of my portfolio to total market funds. They've provided steady 9–11% annual returns over my investing timeline. Combined with S&P 500 funds, they form my investment foundation. The expense ratio is typically 0.030–0.04%. That means you keep 99.96% of returns. Compare that to actively managed funds charging 1–2% annually. Over decades, those fees compound into hundreds of thousands in lost wealth. Start with VT Sachs if you have $3,000 minimum. Use VTI for any amount through fractional shares. This should be the core of most portfolios. Investment 3. International Index Funds. Don't limit yourself to U.S. markets. International funds provide exposure to developed and emerging markets worldwide. VXUS and VTIAX offer broad international diversification. International stocks historically underperform U.S. markets but provide crucial diversification. When U.S. markets struggle, international markets sometimes outperform. This balance smooths overall portfolio volatility. I keep 20% of my portfolio in international funds. During U.S. market downturns, this allocation has protected portfolio value. It's insurance against U.S.-specific economic problems. The world economy is bigger than America. Companies like Toyota, Samsung, and Nestlé offer growth opportunities. International funds capture this global growth potential. Allocate 10–30% of your portfolio internationally. VXUS is an excellent one-fund solution providing exposure to thousands of international companies. Investment 4. Real estate investment trusts, REITs. REITs allow real estate investment without property management hassles. They own income-producing properties and distribute 90% of income as dividends by law. REITs typically yield 3–6% annually in dividends plus appreciation. They provide inflation protection since rents and property values typically rise with inflation. They're also uncorrelated with stocks, providing diversification. I invested $20,000 in REIT index funds 5 years ago. They've grown to $32,000 while paying $1,600 annually in dividends. That's 60% total return plus consistent income. VNQ is Vanguard's REIT ETF, providing diversified exposure. It includes apartment buildings, offices, warehouses, and retail properties. You become a commercial real estate owner with zero management responsibilities. Allocate 5–15% of your portfolio to REITs. They provide income, inflation protection, and diversification beyond stocks and bonds. Investment 5. Dividend growth stocks. Dividend aristocrats are companies that have increased dividends for 25+ consecutive years. These are the most stable, reliable stocks available. Companies like Johnson & Amp, Johnson, Coca-Cola, and Procter & Gamble have paid growing dividends through multiple recessions. These stocks provide growing income that compounds over decades. A 3% yielding stock increasing dividends 7% annually doubles your income every 10 years. After 30 years, you're receiving 10x your initial dividend payment. I built a dividend portfolio of 20 aristocrats starting 8 years ago. My yield on cost is now 6.8% because dividends have grown consistently. These stocks also appreciate, providing total returns of 8–10% annually. During market crashes, dividend stocks decline less than growth stocks. The income continues regardless of market conditions. This provides psychological comfort and financial stability. Build a portfolio of 1–5–25 dividend aristocrats or use Noble ETF for instant diversification. Reinvest dividends to compound wealth faster. Investment 6. Your primary residence. Real estate forced savings through mortgage payments builds substantial wealth. Your home appreciates while you live there. It's the most accessible real estate investment for most people. Real estate typically appreciates 3–5% annually long-term. A $300,000 home becomes $487,000 in 15 years at 3.5% appreciation. Meanwhile, you're building equity through mortgage payments. I bought my home in 2018 for $280,000. Today it's worth $420,000. That's $140,000 in appreciation plus $65,000 in equity from payments. Total wealth increase of $205,000 from housing alone. The tax benefits are substantial. Mortgage interest is deductible. Capital gains up to $250,000, $500,000 married, are tax-free when selling your primary residence. This tax advantage accelerates wealth building significantly. Buy in stable markets with strong job growth. Keep housing costs under 28% of gross income. Stay long-term to benefit from appreciation. Your home becomes a powerful wealth-building tool. Investment 7–401(k) and Roth IRA. Tax-advantaged accounts supercharge wealth building. 401k contributions reduce taxable income today. Roth IRA contributions grow tax-free forever. Both compound without annual tax drag. The math is compelling. A traditional 401k saves 22–32% in taxes immediately for most people. That's 22–32% more money invested. Over decades, this tax savings compounds into hundreds of thousands. Roth IRAs are even more powerful. Contributions are after tax, but growth is tax-free. A $6,500 annual contribution over 30 years at 10% returns becomes $1.2 million completely tax-free. I've maxed 401k and Roth IRA for 10 years. This discipline created $380,000 in tax-advantaged wealth. The tax savings alone exceeded $75,000. That's $75,000 more working for my future. Max out employer 401k match first. Then max Roth IRA at $7,000 annually. Then return to 401k up to $23,000 limit. This sequence optimizes tax benefits and wealth accumulation. Investment 8. Low-cost bond funds. Bonds provide stability and income with lower risk than stocks. They smooth portfolio volatility and prevent panic selling during market crashes. As you accumulate wealth, bonds become increasingly important. Total bond market funds like BND or VBTLX provide diversified exposure to thousands of government and corporate bonds. They currently yield 4–5% with minimal risk. I increased my bond allocation from 10% to 25% as my net worth grew. During the 2022 market decline, bonds cushioned portfolio losses. This stability prevented emotional decisions and allowed me to keep investing through the downturn. The traditional rule is holding your age in bonds. A 30-year-old holds 30% bonds. This gradually shifts from growth to preservation as you age and approach retirement. Start with 20–30% bonds if you're young. Increase allocation as wealth grows and you approach financial independence. BND or VBTLX are excellent one-fund bond solutions. Investment 9. Your skills and education. The best investment is often yourself. A $10,000 course that increases your income $25,000 annually provides a 250% first-year return. No financial investment matches this consistently. Skills compound like investments. Each new skill increases earning capacity. Higher income means more to invest. More investments mean faster wealth accumulation. It's a virtuous cycle. I've invested $40,000 in professional development over 10 years. This education increased my income by over $60,000 annually. That's a 150% return year one, continuing indefinitely. The returns are guaranteed and immediate. Better skills mean better opportunities, higher salaries, and increased earning potential. This ROI exceeds any financial asset over long term. Invest 5–10% of income in skill development. Courses, certifications, coaching, and conferences. Your earning capacity is your most valuable asset. Compound it aggressively. Investment 10. Small business or side venture. Business ownership provides unlimited upside potential. While riskier than index funds, successful businesses can create wealth faster than any other investment. Businesses provide multiple benefits. Income while building. Tax advantages through deductions. Potential sale value when exiting. Well-run businesses sell for 3–7x annual profits. I started a consulting business with $2,000 investment. It now generates $80,000 annually. That's a 4,000% return on initial investment. No stock investment comes close. The key is starting small and scaling gradually. Side businesses minimize risk while providing upside. They leverage your existing skills and interests. Many eventually become full-time ventures. Identify one skill you can monetize. Start on weekends. Reinvest initial profits. Scale as demand proves. This approach minimizes risk while maximizing potential returns. Building your investment portfolio. Don't try implementing all 10 investments immediately. Build systematically based on your situation and timeline. Beginner portfolio. Under $10,000, 70% total stock market index, 20% international index, 10% bond fund. Simple, diversified, growth-focused. Intermediate portfolio. $10,000, $100,000, 50% total market, 20% international, 10% rights, 10% dividend stocks, 10% bonds. Balanced growth and income. Advanced portfolio. $100,000 plus, 40% total market, 20% international, 15% rights, 15% dividend stocks, 10% bonds, plus real estate and business investments. Fully diversified wealth machine. Rebalance annually. As assets grow, sell winners and buy underperformers. This forces buying low and selling high systematically. The power of time and consistency. These investments work through decades of consistent contributions. Time is the secret ingredient most people ignore. A 25-year-old investing $500 monthly at 10% returns has $3.5 million by 65. A 35-year-old with the same contributions has $1.4 million. That 10-year delay costs $2.1 million. Time is irreplaceable. I started investing seriously at 28. I wish I'd started at 22. Those 6 years would have meant an additional $200,000 today. Start now regardless of amount. Consistency matters more than timing. Monthly investments through all market conditions beats timing attempts. Dollar cost averaging removes emotion and optimizes long-term returns. Common mistakes to avoid. Don't chase hot stocks or trendy investments. Stick with proven assets. Don't time the market. Invest consistently regardless of conditions. Don't panic sell during crashes. Markets always recover eventually. Don't pay high fees. Every 1% in fees costs hundreds of thousands over decades. Don't over-diversify. 20 funds aren't better than 5. Don't ignore tax advantages. Use 401k and Roth IRA fully before taxable accounts. Conclusion. Building long-term wealth isn't complicated. It's consistent investing in proven assets over decades. Index funds, real estate, dividend stocks, tax-advantaged accounts. These boring investments create extraordinary wealth through time and compound growth. The wealthy aren't doing anything magical. They're investing consistently in these assets while everyone else is consuming. Start today with whatever you can afford. Increase contributions as income grows. Stay consistent through decades. If this video gave you a clear investment roadmap, hit that subscribe button for more wealth building strategies. Comment below with which investment you're starting with. Public commitment increases follow-through. Remember, the best time to start investing was yesterday. The second best time is today. Your future wealthy self is counting on the investments you make now. Start building your fortune today.